What's the number one thing that gives you an advantage over other traders in the market? That's an easy answer. Understanding volatility. Today I'm going to share with you a foolproof way to read volatility and use it to gain an edge, just like the top professional traders all around the world. Hi, I'm Dan Passarelli, president here at Market Taker Mentoring, or MTM for short. I create systems that make trading simple so you can trade confidently and consistently. I've created a simple way to read volatility so you can have an edge and have more frequent winning trades, bigger winning trades, and smaller losers. It's called the MTM 1, 2, 3 Volatility Analysis. As the name implies, there are 3 steps, and it goes like this. We start out with the single goal of discovering whether options are cheap or expensive. Because stock price, time, interest rates, and more affect the value of an option, it's hard to do just looking at its price. So we do what I like to call normalizing the value. We hold all the inputs into the option value constant and isolate just the market force on the price or the supply and demand pressure. That's called implied volatility. Simply put, if implied volatility is too high, options are overpriced and you're better off selling. If implied volatility is too low, options are underpriced and you're better off buying them. That's where our 3 steps come in. Step 1, compare today's implied volatility to the implied volatility from the past 6 months. That's pretty straightforward. If we want to see if something is high or low, we can just look at a graph or a chart to see if it's higher or lower than it was in the past. If today's implied volatility is in the top half of the 6-month range, that's our first clue it's high and options are expensive. If it's in the bottom half of the 6-month range, that's an indication it might be cheap. Step 2, compare implied volatility to historical volatility. As mentioned, implied volatility is how cheap or expensive options are. Historical volatility is how much the underlying stock or ETF has moved around lately. For all our math enthusiasts out there, specifically, historical volatility is the annualized standard deviation of closing prices from the past month. If you think about it, option prices should have something to do with how much the underlying stock moves. If traders fear volatility, they're more likely to buy options to hedge or buy them to speculate since they have less risk than the underlying stock or ETF if there's a wrong move. That buying would make options more expensive. And when the stock is boring, that's when traders like to sell options, like with a covered call or a credit spread to generate income. That would make options cheaper. So the thing to do in step 2 is simple. Compare today's implied volatility to today's historical volatility. If today's implied volatility is higher than historical, it's an indication it's overpriced and you're better off being a seller. If today's implied volatility is below historical, it's a sign options are cheap. Step 3, look to the future. We never know what the future holds, but with trading, we're always trying to make some guess about it. With volatility, sometimes there are very clear signs of what the future may hold. When a stock announces its quarterly earnings, that can be a volatile day. When the monthly unemployment figures are announced, or there's an FOMC meeting, the market can be volatile too. And sometimes we see no news on the horizon, and stocks are likely to see less volatility. if its volatility is poised to increase in the future, we'd consider being more careful selling options because they have more risk than reward. We might rather buy, depending on how high or low implied volatility is. If volatility is likely to be less going forward, we might want to be careful buying options, and we might opt to sell them, again, depending on the implied volatility level. These 3 simple steps help traders find and set up better trades, pick better ways to trade, and in the end, make more money. I hope this helps. I'm Dan Passarelli. Trade smart.